Interest rates. It's this like invisible thing that affects everything. Yet few people understand the connection, especially when maybe you don't have debt. But it is the underlying current that dictates almost every part of your life, whether you have debt, assets, or not. Today, we're going to look at what is going on with interest rates and how that changes the very world we live in and experience day to day. First, we got to start with the central banks. You see, the central banks set interest rates, which then get passed down through the economy. Now, when it goes down through the economy, we have the open marketplace, which can dictate interest rates. It's not like the Fed can magically override, but they do set the stage. And so interest rates generally track that. So when the Fed moves down interest rates, that gets generally passed down. Maybe not exactly, but overall, yes. So when central banks are doing this, what are they trying to achieve? As in, what is their mandate? The Fed or the central banks are trying to achieve two things. First, price stability. Think about inflation. When prices raise too fast, the Fed increases interest rates because debt is money. So the less money there is, the less demand there is for goods and services. That makes inflation go down. When you have prices that do the opposite, not inflation, but deflation, everything starts dropping, which causes depressions, the Fed lowers interest rates, sending money into the system, and more money equals more demand, so prices go up. Their next mandate is maximum employment. So the Fed is looking very close to lower rates when unemployment rises. And yes, when unemployment gets low and the economy is heated, we can have employment crises. This is an overheating of the economy, and the Fed will increase rates and look for unemployment to rise before they lower them. This is a very controversial subject because a lot of people debate the role of the Fed, central banks, within the economy, especially when their actions are part of the normal business cycle and they intend to create unemployment and lower prices. Now, it's for the good of the whole, but people disagree massively on that and if it really is or not. So while we're going through this, please let me know in the comments what you think, because some people don't think that central banks or the Fed should even exist. When the Fed lowers those interest rates, it stimulates the business investments and hiring. So unemployment at 4.4 is considered stable. For the last while, we have seen inflation and really low unemployment. The Fed wanted to change that. They're looking to decrease inflation, right? That overall price stability, making sure that it's not run away, because that makes all of us poor faster than anything else, while maximizing employment. The problem is these things can be at odds with each other. The important thing is your day-to-day life is directly affected because every single employer and the economy is affected by these two things and the decisions that the central bank makes. We see a lot of this in political discourse, especially today, when we have an administration who is very unhappy with the central banks because they want the economy to grow faster. But the central banks are worried about inflation. Once again, debate that in the comments. First, the overarching things that it affects. Then we're going to dive into what you feel even if interest rates don't affect you, or you don't have debt, or your interest rates aren't changing. You are still massively affected just like everybody else. Credit cards. Credit cards are an essential part of Americans' lives and businesses. They are the gap when they can't afford or pay. High interest rates make it harder for people to bridge the gap, It also compounds and becomes a hole that they can't escape out of. The higher the interest rate, the less you can afford, but more importantly, the faster that compounds, making that debt more and more burdening Americans and businesses. Savings. Savings yield, how much you're making from having it sit in the savings account. That will depend on interest rates. Stocks. The movement of money in the entire economy moves according to interest rates. Why? Because of optionality, meaning if I'm getting a safe high yield here, I don't need to invest in assets. So money will shift. They'll move from real estate to stocks to savings accounts and sitting on the sidelines to moving into those different asset classes based upon where interest rates are. So real quick, before we jump into how you're affected outside that direct causation of an interest rate going up or down, let's take a look at where we are. In 2023, the Fed's fund rate hit peak at 5.5%. It is now at 3.75%, and it has been lowering as inflation came down due to that Fed mandate. The latest guidance was that the Fed was going to hold rates, as in they weren't going to change them. This happens all the time, and that's why it's big news, because the market is waiting and will price in accordingly. Inflation was 2.7%. Their target is 2%. So although it's higher, it is substantially lower than what we have seen in the past 4 years. GDP growth continues at 4.3%. That is a really good GDP growth. The Fed's balance sheets, or assets that they hold, has been shrinking. And as for the outlook, the market is expecting 1 to 2 more cuts this year. Things that we need to look out for is leadership change. Powell's term expires in May of 2026, and given the political war of the administration against the Fed, the administration choose who goes in, I think the market's thinking they're going to pick somebody that will lower rates. And they are betting on it. The dilemma that they have right now: strong growth versus sticky inflation. You have growth, but inflation is not quite coming down to where they want to see it. So by lowering interest rates, inflation, they're worried, will pick up. If we didn't have strong economic GDP growth, then the Fed would lower interest rates to expand it. Now, I know what you're saying. Why do I care about GDP growth? I don't feel the effects of it. The overall economy may be growing, but my personal position is not. Well, the Fed cares about it, and that's why it's important. Now let's look at the ripple effect, kind of putting it all together. First thing that we have is the government. The government's interest payments are astronomical. We're at basically $1 trillion. That means your tax dollars, 19 cents of every dollar goes to just paying interest. $7,300 per household goes to interest alone. It is the second largest item, even more than defense spending for the United States. And that is projected to grow to $1.8 trillion by 2035. The domino effect, the chain. The Fed raises rates, banks pay more to borrow, banks charge you more, people and businesses borrow less. Spending slows down. Companies earn less, there's fewer jobs. Housing cools and stocks shift. This works in reverse. Lower rates, more borrowing, more spending, more jobs, more growth. Now let's look at the overall impact, even with zero debt. Rents, landlords, they pass higher mortgage costs to you. Groceries, companies borrow to operate. Higher cost equals higher grocery prices. Your job, higher rates means businesses cut. They do higher freezing and layoffs because they can no longer have access to capital to grow. Plus, their consumers are more tapped out. Retirement. This changes your overall retirement. We're talking 401k, stocks, bond values, all of it. And savings. Higher rates equal better savings yields. And as far as what you're actually paying, mortgages 3% to 6.7%. New car loans 3.9% to 6.7%. Your credit card, the average APR 16 to 19%. Your savings, high yield accounts 0.06 to 4.5%. Mortgages by far were the biggest hit. Basically $1,600 a month at 3% is now $2,500 a month. The extra cost from those higher rates is $899 per month. Over 30 years, that's $323,000 that you will pay that you don't get. How much is that for the car loan? If you have a $42,000 new car and it's financed, you go from $775 a month to $828 a month. Credit card balance of $6K, $978 a year to $1,100 a year. So interest rates are the central focus because they are the tidal waves of the economy. They move everything, and it affects every single aspect of your life, whether you know it or not. This is why it is such a heated debate. It is also why you need to understand interest rates. This helps you understand where asset prices are going, opportunities, and also dangers. It tells us where the money's flowing, and it tells us how you can prepare. Most people are never taught about the relationship between the Fed, the central banks, the government, and the economy. This leaves people confused and worried. So let us know, what did I miss? What do interest rate and central banks policy changes affect in your life? And make sure you like and subscribe so you can learn more about where to watch out for and the opportunities that are out there.